There's this one piece of investing advice that's so common, it pretty much feels like an absolute truth. But what if that so-called common wisdom is actually costing you a fortune? Today, we are going to pull back the curtain and debunk the number one myth in investing.
Yeah, you've heard it a million times. It's the golden rule, right? Whispered from Wall Street pros all the way to your uncle at the family barbecue. And look, on the surface, it sounds so smart, right? So simple. Of course you want to buy something when it's cheap and sell it when it's expensive. I mean, that's the whole point. But here's the real question we've got to ask. Is this simple phrase actually helpful advice you can use, or is it one of the most useless and maybe even dangerous sayings in all of finance? Let's find out. All right, first up, is this really the ultimate investing rule? We're going to dig into why this piece of common wisdom can be so bad for your wallet.
Okay, so here is the absolute core of the problem. Buy low, sell high. Well, it isn't a strategy, it's a goal. It's exactly like telling someone who's feeling down to just be happy. Yeah, you've described the perfect outcome, but you've given them zero practical steps on how to actually get there. And that total lack of a real plan? It leads us straight into our next big issue, the timing trap. This is where so many good intentions go to die, because people get stuck trying to predict the unpredictable. Trying to perfectly time the market, to find that absolute lowest point to buy, it just leads to what we call analysis paralysis. You're so scared of getting it wrong, of buying just before it drops a little more, that you end up doing nothing. You just wait. And while you're waiting, trying to be the smartest person in the room, the market just keeps moving on without you. Look, the hard truth is there are no signals. Nobody rings a bell at the bottom to tell you, okay, buy now. And nobody rings one at the top to say, time to sell. Even the pros with all their fancy computers get it wrong constantly. For the rest of us, it's not investing. It's pure guesswork. So if it's just a big guessing game, what's the real cost of getting it wrong? Let's look at the data, because honestly, what it says about trying to time the market is pretty shocking. So Morningstar, one of the biggest names in finance, did some digging. And what they found is that the average investor consistently makes less money than the actual funds they're invested in. How much less? About 1.2% every single year. And the main reason for that gap is bad timing. We get scared and sell low, then get excited and buy high, the exact opposite of what we're told to do. And if you really want to see how dangerous this guessing game is, just look at this chart. Over a 20-year period, if you just stayed in the market, you got the full returns. But here's the crazy part. If you miss just the 10 best trading days in those 2 decades, your total returns get cut in half. 10 days. That is the massive, devastating cost of sitting on the sidelines. And here's the kicker, the real twist of the knife. Those super important best days. They almost always happen right after the absolute worst days. It's during those moments of maximum panic, when every single instinct in your body is screaming, sell or stay out. That's when the market has its most powerful comebacks. And if you're not in, you miss the whole thing. All right, so we've pretty much established that trying to time the market is a total trap. It's stressful, it doesn't work, and it costs you a ton of money. So what's the alternative? Well, let's talk about a simpler and frankly much smarter strategy. It's a strategy called dollar cost averaging. And the whole idea is to take the emotion, the guesswork, completely out of the equation. You simply invest a fixed amount of money, say $200, on a regular schedule, like the first of every month, no matter what the market is doing. That's it. It's all about discipline and automation. And seriously, it is this simple. Step 1, pick an amount you're comfortable with. Step 2, put it on a schedule and just let it run automatically. And step 3, the most important part, ignore the day-to-day noise. When prices are low, your money automatically buys you more shares. When prices are high, it buys fewer. It's simple math that smooths out the ride over time. So let's put these two strategies head to head. It's like a showdown. With market timing, your action is constant guessing. Your emotion is high stress. And the proven result, underperformance. With dollar cost averaging, you just automate and forget. The emotion is low stress, and the result is a focus on consistent growth. The winner here is pretty obvious. So, all of this brings us to the most important point of all. It's time to completely redefine what it actually means to be a smart investor, because it's probably not what you think. See, a truly smart investor isn't some crystal ball gazing genius. They're disciplined. They know that consistency, just showing up every month, is way more powerful than trying to be clever. They automate everything to take their own emotions out of it. And above all, they live by the real golden rule.
The key is focusing on time in the market, not trying to time the market. And that really leaves us with one last crucial question you have to ask yourself about your own approach. Is your strategy built on discipline? Or is it really just a gamble, a bet that you'll get lucky? The answer to that one question might just define your entire financial future.